Saturday afternoon, the apartment is quiet. A laptop sits open on a kitchen counter next to a half-finished iced coffee. The Brokerage app is loaded. A search bar blinks at the top. 3 letters get typed in, then 3 more. 2 taps later, a confirmation screen appears. Shares purchased. The whole thing took 90 seconds. And the person sitting there feels genuinely good about it, like something responsible just happened. That feeling is real, and it is not wrong, but it is incomplete. And the distance between incomplete and informed is where most of the money gets lost. This is not a video about why ETFs are bad. They are not bad. For a lot of people, they are the single best invention in modern retail investing. But there is a version of the ETF story that gets passed around online, repeated in Reddit threads and TikTok explainers. That goes something like this. Just buy an ETF. You are automatically diversified. Fees are basically zero. Sit back and let it compound. And every piece of that sentence has a footnote that nobody reads. I should be upfront. I am not a financial advisor. I am not telling you what to buy or sell or hold. Nothing in this video is personal investment advice. I am just someone who started looking into this stuff because I got curious about what I was actually paying for. And what I found surprised me, so I figured it was worth sharing. This is the story of one person, a beginner, someone who did what the internet told them to do. And how, step by step, the things they did not know started to add up. The person's name is Sage. Sage is 26, lives in Columbus, Ohio, works in logistics coordination, pulls in about $58,000 a year before taxes. After rent, car payment, groceries, utilities, and the streaming subscriptions that somehow multiply on their own, Sage has about $400 a month that could go somewhere. For a while, that somewhere was a savings account earning almost nothing. Then one night, Sage watched a 12-minute video that said something simple. Stop letting your money sit in cash. Open a brokerage account, buy an index ETF. Let compound interest do the rest. So Sage did. Nobody tells you how satisfying that first purchase feels. It is this small private moment of feeling like you have crossed some invisible line between people who invest and people who do not. Sage did not tell anyone about it for 2 weeks, just checked the app every morning, watched the number move a few dollars, and felt like something important had started. And it had. That part was true. The first thing Sage did not know was about the gap between what an ETF costs on paper and what it costs in practice. The expense ratio on the fund Sage picked was listed at 0.03%. That number is real. It is low. It is one of the lowest in the industry. According to the Investment Company Institute, the average expense ratio for index equity ETFs in 2025 was 0.14%. Vanguard's asset weighted average across all its funds dropped to 0.06% as of early 2026. So Sage looked at 0.03% and thought, basically free. And this is where most people stop reading the fine print. That 0.03% is the management fee. It does not include the bid-ask spread, which is the difference between the price you pay when you buy and the price you get when you sell. For a massive liquid fund tracking the S&P 500, that spread is usually a penny or two per S-hair. Tiny, almost invisible, but for the second ETF Sage bought a few months later, a smaller thematic fund focused on clean energy, the spread was wider. Not dramatically wider, but consistently wider. And every time Sage bought shares, that spread was a cost that did not show up on any fee disclosure. FINRA notes that bid-ask spreads represent a real transaction cost for ETF investors, and that less liquid ETFs, or those holding international or thinly traded securities, tend to have wider spreads. Sage did not know this. Sage saw a zero-commission trade confirmation and thought the trade was free. There is a quiet kind of education that happens when you realize that the price you paid and the price on the screen are not always the same number. It does not feel like a crisis, it feels like a small adjustment to something you thought you understood. But here is the part that actually matters. 6 months in, Sage owned 4 ETFs, a broad market fund, a tech-heavy one, a dividend-focused one, an international fund, 4 funds. Sage felt diversified. The portfolio screen showed different names, different ticker symbols, different colored pie slices in the allocation chart. It looked like diversification. It was not. According to ETF Research Center data, the overlap between a standard S&P 500 ETF and a NASDAQ 100 ETF is roughly 50% by weight, with around 88 overlapping holdings. 87% of the holdings in the NASDAQ 100 fund are also in the S&P 500 fund. Sage owned both, which means a significant portion of what Sage thought were two separate bets were actually the same bet. Counted twice, weighted toward the same handful of mega-cap tech companies. And the dividend fund, it shared dozens of overlapping holdings with the broad market fund. Less dramatic, but still not what 4 separate slices of a pie chart would suggest. Sage was not diversified across 4 strategies. Sage was concentrated in one strategy, wearing 4 outfits. That is what overlap looks like from the inside. Not like a mistake, like a dashboard that tells you everything is fine. Nobody talks about this at parties. Nobody posts a screenshot of their portfolio, overlap analysis. Everyone just looks at the pie chart, sees 4 colors, and moves on. The second year is when things got more interesting. Sage had been adding $400 a month, split across the 4 funds. The account had grown, not by a lot, but enough to feel like momentum. And then, in the spring, something unexpected showed up, a 1099 div. Sage did not sell anything. Sage did not take any money out. But the funds had made distributions dividends, and in the case of one fund, a small capital gains distribution. All of it reportable income, all of it taxable. This is something the internet gets quietly wrong about ETFs. ETFs are more tax efficient than mutual funds. That part is true. According to a 2026 report from State Street Global Advisors, only about 7% of ETFs distributed capital gains in 2025, compared to 52% of mutual funds. Since 2016, the long-term average has been 9% of ETFs versus 53% of mutual funds. The mechanism, the in-kind creation and redemption process, structurally reduces taxable events. But reduces does not mean eliminates. Dividends still get paid, they still get taxed. And in a taxable brokerage account, which is what Sage had, those dividends are taxable every single year, whether Sage reinvests them or not. And here is where it got personal. Sage had turned on automatic dividend reinvestment, which meant every distribution was used to buy more shares at a slightly different price. Each reinvestment created a new tax lot. By the end of year 2, Sage had dozens of individual tax lots across 4 funds, each with a different cost basis. When Sage eventually sells, the capital gains calculation will not be one number, it will be dozens. Sage did not do anything wrong. Sage followed a system. And the system generated a tax complexity that nobody mentioned in the original 12-minute video. Every brokerage that earns revenue from assets under custody. Every platform that shows you a confetti animation when you make your first trade. Every content creator who gets affiliate revenue from account signups has a structural incentive to make the entry point feel frictionless. None of them make money when you slow down and read the footnotes. Now, let me be clear, the mistakes Sage made are not catastrophic. A few basis points of spread here, some unnecessary overlap there, a tax bill that was surprising but not devastating. Individually, each one is small, but this is where the math starts to matter. And this is where most people think the story ends. It does not, it gets heavier. Let me run the numbers on just the expense ratio piece. Because this is where the difference between 0.03% and something higher becomes a real dollar amount you can feel. Say Sage keeps investing $400 a month for 30 years. At an average annual return of 7% after inflation, a fund with a 0.03% expense ratio grows that money to roughly $453,000. Now take the same $400 a month, the same 7% return, but run it through a fund charging 0.75%. That is higher than the average expense ratio for equity mutual funds, which the Investment Company Institute reported at 0.40% in 2025. That account lands at about $397,000. Same contributions, same market, same person. The difference is around $56,000. That is not an opinion, that is subtraction. And 0.75% is not even the worst case. Some niche ETFs charge over 1%. Some target date funds inside employer plans charge even more. The gap widens the longer you hold. Sage picked a low-cost fund. Sage got that part right. But Sage's second and third ETFs were not as cheap, and the blended cost across the portfolio was higher than the headline number on the cheapest fund. There is a feeling that sets in around year 3 of investing. The initial excitement fades. The app checks slow down from daily to weekly to maybe once a month. The contributions are automatic. The portfolio looks like it is growing. And in that quiet space between setup and retirement, the small things compound in both directions. The returns compound, but so do the costs, the overlaps, and the tax drag. It is like a slow leak in a tire. You do not hear it, you do not feel it in the steering. You just notice one morning that you are a little lower than you expected to be. By any reasonable standard, Sage is doing better than most 28-year-olds. Investing consistently, keeping costs mostly low, not panic, selling, not day trading meme stocks. Sage is exactly the kind of investor that the system should reward. And it does reward Sage, just not as much as it could, because the default settings have quiet costs baked in that nobody volunteered to explain. The combined assets of U.S. ETFs reached $14.21 trillion in February 2026, according to the Investment Company Institute. That is up from about $10.3 trillion at year-end 2024. Money is flooding into these products. Millions of people are doing exactly what Sage did, following the same advice, using the same apps, making the same confident first purchase on a Saturday afternoon. And the vast majority of them will never check their overlap, never calculate their blended expense ratio, never think about the tax lots piling up inside their reinvestment settings. Not because they are careless, because nobody told them to look. That is not a conspiracy, it is an asymmetry. The information is available, it is just not placed anywhere near the buy button. So what would Sage do differently, knowing what Sage knows now? Maybe check the actual holdings list before buying a second fund that tracks a different index but holds the same top 20 stocks. Maybe put the tax-inefficient dividend fund inside a tax-advantaged account instead of the taxable brokerage. Maybe turn off automatic reinvestment in the taxable account and reinvest manually once a year to simplify the tax lots. Maybe just own 2 funds instead of 4 and get the same exposure with less noise. None of these are financial recommendations. They are descriptions of how the mechanics work. What you do with that information is yours to decide. Here is what stays with me about Sage's story. Every step Sage took was reasonable. Every choice was based on something a trusted source recommended. There was no moment where Sage was reckless or uninformed in any obvious way. The gap was not between smart and stupid. It was between the first layer of understanding and the second layer. And almost everything you see online about ETFs lives on that first layer. You are watching this video, which means you are already the kind of person who looks for the second layer. So here is the question I will leave you with. It is not a hard question. It takes about 5 minutes. When was the last time you opened your portfolio and looked not at the total balance, not at the daily change, but at what is actually inside each fund you own, and whether the thing you think you are paying for is the thing you are actually getting?